Welcome to the Trader's Arsenal, where you will find various helpful videos to level up your trading career. In today's episode, we will be going through a brief introduction to price action trading and why you should consider incorporating it in your trading strategy. We will also be uploading tutorial videos on the individual price action patterns that are commonly used by traders. It will cover a variety of entry, stop loss, and take profit methods which you can use easily. Do remember to follow us on our social media platforms so that you will always be updated whenever we post a video. Without further ado, let's get started. So what exactly is price action trading? Simply put, you are just trading based on the recent and actual price movement without the use of indicators. Some of the more commonly used patterns are the head and shoulders pattern, double top, double bottom, and the bull and bear flag patterns. But of course, there are a huge variety of price action patterns you can employ to trade the markets. Having said that, there is no need for you to know and trade every single price action pattern out there. If you are new to trading, start off with one or two patterns that you are comfortable with and slowly increase the number of patterns as you progress. It is better to fully understand the mechanics of a few patterns first, rather than trying to trade every single pattern which you might not have a deep understanding. Let's look at price action trading versus trading using only indicators. As some of you may know, indicators are classified as either leading or lagging indicators. Leading indicators will give you a signal before a change in price happens, while lagging indicators does the opposite, where the change in price would have already happened before a signal is given. If you are trading solely based on indicators, you might find yourself having trouble staying consistently profitable in the markets. More often than not, indicators may provide you with false signals and you may miss out a huge chunk of the move. Hence, it might not be as reliable as you thought. Let's look at one example. This is a classic false break setup, where you see a strong move coming towards the level of support with the price closing below it. On the next candle, you can see a strong bullish candle, closing back above the support level. Based on this price action, what does it say? It tells you the sellers tried to push price below the support level, but they were not able to maintain below the level. If the sellers are strong enough, the price would have continued going down lower. However, the buyers came in and managed to push the price higher. Looking at the size of the two candles, the buyers are clearly stronger. This is actually a buy signal and you should have entered on the close of the bullish candle. Your take profit will most likely be on this swing low and stop loss just slightly below the candle. The potential risk to reward ratio on this trade is roughly 1 to 1.3. Using the same chart, and let's now assume you are trading based on the moving average crossover. The orange line represents the 5-period moving average while the black line represents the 20-period moving average. Based on this strategy, when the 5-period moving average crosses above the 20-period moving average, it is a buy signal and you will only enter long at this candle. Your take profit level will be at this swing and stop loss will be slightly below this swing low. Visually, you can tell that your risk-to-reward ratio is roughly 1 to 0.25, which is significantly lower than the previous setup. This is actually the reason why you might lose a huge chunk of the move if you trade solely based on indicators. In conclusion, why should you trade price action? The first reason is that there will be less clutter on the charts. Having a lot of indicators means your charts may be messy and difficult to do your analysis. If you trade price action, you can do so with a clean chart. Since price action trading is based on the recent or actual price movement, you are letting the market tell you what to do instead of relying on an indicator which may or may not reflect the true market situation. Lastly, you can improve your risk-to-reward ratio. As you have seen the previous example, if you trade based on indicators only, you may miss out on a huge chunk of the move, or if you are unlucky, you might even get stopped out. Of course, indicators does have its uses and you should not totally avoid it. What you can do to improve your win rate is to trade price action in conjunction with an indicator as a confirmation. This will be covered in the subsequent videos. That's all for today. If you enjoyed this video, do remember to follow us on our social media platforms so that you will always be updated whenever a new video is uploaded. Thanks for watching.